Hi and welcome to Carnegie and our interview with Zwipe. My name is Mark Salmerd. I'm an analyst here at the bank. I have Robert Puskaric, who is CEO at Zwipe, with me. A warm welcome.
Thank you, Marcus. Always a pleasure to be here again.
So you released Q4 and half-year earnings yesterday.
Correct.
You have exited Pay. We talked about that before, so I thought that maybe we could focus on Access today, which is the business where you will have complete focus going forward.
Correct.
So if we just start by an open question, how has the access market developed in the past 6 months?
Let me kind of just touch briefly on Pay. And it is absolutely correct, and we talked about that. We made an announcement on 16th of January this year, having then concluded on what was the status when we closed the books last year or this year, and that we communicate to the market. The thing I kind of want to just people to kind of remember, and one takeaway on Pay is that everything we do on Access and Pay is built on the same platform, right? So it's the same product, but it's a different software that we load on it. So I've gotten questions about, have you now destroyed the value of Pay, and what happens if the Pay market comes back, and are you going to sell assets that are connected to the Pay platform and so on? Again, it's one platform. The only thing that we have decided is not to put any effort going forward on taking Pay to the market. If the Pay market would kind of bounce back and become what was expected 1 or 2 years ago, we are ready to address that market again. I mean, it's not so that we have scrapped the platform. We have just put it on hold, and we are not kind of directing our investments in that area. All the focus now is on taking the product to the access market as a use case.
And I guess this has to do with also cost position, not worth it to put investments into that business until you know that it's taking off, and just being conservative and preserving.
I mean, we have a need to
have.
come down in run rate to make the money that we just raised to last as long as possible, and there we see that the cost we could make was in the Pay area, because there we didn't see any market traction at the moment. So we redirected all the resources that we have, and also had to scale down. And with that, now we see that we have a path to cash flow break even in 2025 if we follow this plan that we have now.
So the reason why you closed down Pay was that you didn't see any traction, the market didn't take off. Yeah. And it's the opposite in Access. In Access, you've had a good half year, you've seen plenty of traction, plenty of new deals. So talk a little bit about that.
Yeah, I mean, I think it was at the beginning of 2023, a year ago, where we communicated our kind of updated strategy at that time, because up till that moment, the focus, I would say 95% of the company was in Pay, because that was supposed to be the high volume product and a quick market takeoff, right? And market uptake. While Pay was like handled by one salesperson, basically. And then in the strategic review that we did in the fall and the winter of 22, we decided that we will kind of treat this on equal terms, because we saw a huge potential in Access as well. And then we kind of started building the go-to-market, not ambitions, but efforts, right, into the market, because you need people out in North America, you need people in Central Europe, in Western Europe, in Nordics, and so on. So we started hiring people, and what we have hired throughout 2023 is experts in the access market, people that have worked with, ASSA ABLOY, HID, Legic. They know this market, they know the partners, and they know how to position this type of new products, right? Would we kind of wish to have even more traction in 2023? Yes, absolutely. But you also have to remember that we started from scratch on the go-to-market, basically in end of Q1 last year, 2023. So we have really been pushing for, I would say, approximately 1 year. And if I then compare the amount of interest that we have talking to the partner network, which is the value-added resellers, distributors, the system integrators, the installers that are working with individual enterprises that will in the end be the users of our product, it's like an astronomical difference in interest and engagement versus what we had with the smart card manufacturing partners in the pay segment, and the banks. I mean, here you really have a dialogue. People want to try it out. They want to put it in the hands of the employees of the company, and they really understand that this is increasing security. So it's a company. It's more a B2B business than a B2C, because there is no consumer that kind of needs. Oh, why should I buy this? You know, it's a company.
And I think it's because of where we are in this. I think it's important maybe to dig in a little bit to get a bit more color on how it works, because there is no. I mean, there's very little revenue yet.
Yes,
here.
correct.
So you talk about strategic partnerships. You have a lot of proof of concepts. Words like pilots are floating up the surface, etc. Explain a little bit how you work. What's your go-to-market strategy? How do you work with your partners? What kind of proof of concepts and pilots do you have out there? And then we come to revenues in just a second.
I mean, the go-to-market is built on. I mean, if we would compare pay and access, if we just kind of briefly touch upon that. In Sweden, as an example, I think there are 16 companies, 16 banks that have a full banking license that can issue cards, right? But then you can ask yourself, so how many enterprises do you have in Sweden that have like 500 employees or more, or 100 employees and more? I mean, there are tens of thousands, right? So then you understand the kind of the things that you need to reach. How do you reach 10,000 companies versus 16 banks? 16 banks, you can have a person employed to go and talk to all of them, right? But 10,000 you can't. So the go-to-market model, in order to be able to scale, and after the initial deals that you have more kind of a catch-up effect, you need to work with the ones that have touch points in the market to reach these 10,000. And typically on the top of that chain, you have a value-added distributor who is actually doing something with the cards. They typically kind of load credentials on the card, maybe they even print on the cards, and then they kind of ship it to the end user enterprises. But the deal to introduce new type of products is typically done by the system integrators and installers. They are the ones that are out on the site of the end user enterprise, right? You know, installing readers on the doors. They know what readers are there. They have surveillance cameras. This type of you know, complete security solutions. And then, of course, we are working with both the value-added distributors, but those you typically have like 1, 2, or maximum 3 in a country. And then you have the system integrators and installers that are many more, that are then reaching, let's say, all the 10,000s of companies that exist in the country. And this takes some time to build up. Then back to pilots and proof of concept.
Yes.
Right? Yeah.
Yes.
So if you want to work with a system integrator, let's say Sartego in Sweden, or if you take MC Dean, right, that are serving some of these like global data center companies, the top 3, then you can figure out who they are. I mean, before they will go and propose something to one of the top 3 global data center providers, they themselves, as a system integrator, as a tech company, they of course want to know that this works, right? So they will first do a proof of concept, like, you know, send me 5 cards, send me the enrollment mechanism, and me and my technical department will evaluate how this works, right? If this works, then typically they will then propose to an end user enterprise that they should do a pilot. And a pilot will typically be somewhere between, you know, 50 to 100 cards that they will maybe use for, you know, 2 or 3 months. But then you're putting it in the hands of ordinary employees that need to enter some kind of premises every day. That's more of a pilot.
And that was, for instance, Richmond Airport was such a pilot.
That was a pilot, yes. And that was then, I mean, that was Tadera, former Civics, that is our system integration and installer partner, that then worked through Safe Sky Alliance, which is like a body coordinating different things for airports when it comes to security. And then they kind of orchestrated that they wanted to conduct this test themselves, but also at the Richmond Airport. So now you can say that in their report, all the associated, like 99 other airports that are connected to Safe Sky Alliance, they don't need to do kind of the POCs, right? So they just have to decide, okay, so we want to order 100 cards. to see how it works among our employees, right?
Because the cards work on the existing readers, right? You just need to take the card.
The HID and the
Legic
readers.
card.
Yes, absolutely.
And then,
yes, absolutely.
And I mean, HID and Legic is what, 80% of the market, something like that? No, 30% of the market.
It's the other way around.
30% of the market.
Yes. And let me touch upon that one, because maybe you haven't prepared that question, I don't know. But the thing is that we're also looking into, how can we get our hands on a product that we don't have to that we don't have to start developing from scratch, in order to, in the market dimension, in our offering, to have HID Legic and MyFair Desfire as an offering, right? In the first step, because when you work with partners, you don't want to limit yourself to say, oh no, we have a product that only works for a selection of the market. They want to say, okay, if we go into an enterprise and we talk about biometric access cards, we will be able to do that regardless of what is actually installed. Not that we have to ask the question like, is it HID or Legic, or else it won't work. So you want to create as much traction as well. And I think that we have a few things up our sleeve that will make it possible for us to actually offer the full range of what is needed in order to open any door.
And the other proof of concepts or pilots that you had, like Berkshire Hathaway Energy, which is a huge energy group. You have one of the top 3 cloud providers, etc. How are those progressing, and what's kind of?
I would say that it's in various stages of that they have done their POCs and they are kind of doing pilots or themselves, or the pilots have even been pushed into the end user enterprises that these companies are serving, right? So if you ask me, are we progressing or are we standing still? No, we are progressing, but of course it's stepwise, right? And again, remember that we didn't have anyone in US like 3 quarters ago. Now we have a person in US who is working with all these Fortune 100 companies and Tadera and Matrix and all the other ones that you have that we're working with. So if you ask me, do we have a good market traction, and was the decision right to go on access versus pay, where we saw no traction from the issuers, so to say, are very, very weak at the moment, it was of course a wise choice to turn to access, because there is very good dialogues ongoing. Now we need to convert that into orders.
Exactly, because that's my next question. If we move from pilots and POCs and traction to hard numbers and in terms of revenues, what are your expectations if I look, 12 to 24 months forward in terms of revenues?
I mean, what we have said is that if things go according to plan, the plan we have laid now, we will be we will be cash flow break even in 2025. So for me right now, it's much more important that we demonstrate a market fit, that we actually manage to close deals, which means closing and communicating end user enterprises, so that we can show the world, that the investors and owners, that people want to buy our product. That is the #1 priority. Close deals with end user enterprises together with our partners. #1 priority.
And you're confident that you will be able to show some of that in the coming
in Q1, Q2. First half year, it's a must.
Yeah,
it's a must. So we understand kind of the disappointment, if I should put it that way, from investors and the market when we're not delivering on 2023. I would say that the whole industry was counting on that we were having an inflection point in 2023, and it looked good also with the deals that we communicated, having launched then MEPS and KIB in Middle East in May. But then it kind of stopped, and it didn't stop only for us, it stopped for everyone.
Yeah, exactly. So it was not just
it's not something that we have done right or wrong. It's just like what everybody have been pouring money into did simply not materialize in form of a kind of demand point of view. So then we need to turn elsewhere. So we are pivoting the company now to take the same investments and platform that we have developed, which is really, really good, and using that into a different use case, which is security and access.
And of course, when you're turning focus like this, it also has an implication for your cost base. You're cutting costs quite severely, and you aim to cut costs by some 40 million NOK in 24 versus 23. How is this progressing, and when should we see the full effect of this?
I mean, we started doing the cuts when we communicated it on the 16th of January, of course. But then, I mean, people have different type of employment contracts, and we have contracts with our partners and suppliers and stuff. But everything is progressing according to plan, and we will, of course, already in just a few months come down on a different burn rate, where you will see the full effect of that starting basically Q3.
Because you have about, including the money that you got in January, you have some, if I remember right, 66, 67, something like that, million kronas in cash right now.
Comment on that right now.
And I think the burn rate has not come down in Q4 versus Q3, but it should obviously come down as costs come out.
Yeah, I mean, remember that we communicated a downsizing and restructuring in June as well, right? And that, of course, gave us an effect that was fully visible at the end of last year, which is then fully visible in Q1 for us. And now with the adjustments that we're doing now, they will be fully visible in Q3. Yeah. So now we are very confident. We have, on the cost side, that is something that you can control 100% yourself.
Yeah.
And that we have to do. That is the only responsible way to act, right?
And we should definitely expect, I mean, coming down from the 10 million a month.
Yeah, absolutely.
Significantly lower,
significantly. I mean, we understand that, I mean, building this go-to-market machine and partner network and so on takes a bit of time. And that's why we also had to do this restructuring, so that we can make our funds last as long as possible until that is achieved, right? And not to burn cash on things that we don't believe will give us any positive effect.
Because all else equal, I mean, if I do my math right, and you come down in burn rate, and with the cash that you have, and then you also have the convertible that comes in at the end of this year, you should have enough to take you to the cash flow positive if you reach your target of becoming cash flow positive in 2025, right?
That's the whole aim.
Yeah.
That's the whole aim. That is what I want to deliver to our shareholders and investors. Absolutely.
Robert, I'm looking forward to seeing deals closed in the coming months.
Absolutely.
And thank you very much for coming here to talk to us.
Thank you, Marcus.
And thank you for listening.
Thank you.